You're being told that 6 Florida cities will crash in 2026. Cape Coral, Port St. Lucie, Lakeland, Punta Gorda, Palm Bay, and Tampa. Now here's what they're not telling you. The prices have already dropped there. Could they fall a little more? Yes, they could. But yields can be rising at the same time. So it's a very interesting point of entry. And if you underwrite correctly, this crash that has occurred can become the most successful point to start building your portfolio. So headlines reward fear. That's the thing that's out there right now. But is it fear and those headlines that actually make people money? No, it keeps them on the sidelines. It's the true operators, the investors, and they reward with the real math, not the headlines of fear. Now, some Florida submarkets are overheated. Absolutely, especially the emotional markets I talk about that are priced at least twice the amount of the median value for that area. Those are going to see more correcting. But the question is a crash going to happen or not? And especially in which markets? The question is, what do the numbers say at the parcel level? If you can verify insurance elevation, CDD, HOA, and the 1-year tax reset, you can buy the correction instead of getting crushed by it. And this is where investors make most of their money in unknown times when a price drop has just occurred. So the first city is Cape Coral. And so what you have to look for is avoid low elevation legacy stock and high priced emotional. What is renting? What's affordable? Target a little bit inland. Make sure, again, it's on elevated land where you're not getting stuck on that lower land, because when you're lying that lower land level, your insurance could be 5 to 7 times more. And also, is the property built to today's standards where it's wind mitigation friendly? And that's going to help save you a ton of money as well. So price the insurance renewable, not the teaser. Make sure you get a real quote and you can do fine. We're pacing these every day in Cape Coral on actual quotes, and people are shocked about how low it actually is. New build with a clean wind mitigation report, and that turns a scary headline into a defensible premium and a stable rent. And also, with the right insurance, it can up your cash flow. Okay, city number 2, Port St. Lucie. Our play, focus on yield, not bragging rights. Again, you're looking for that big, pretty emotional property. Well, you're going to have some problems, not in looks, but in returns. Hunt the product that rents to real median incomes, not some higher out of the range rental where you're looking for that rare renter who can actually afford that higher rent. You want to stay in the affordable range and keep amenities lean to keep the HOA lean. When you go into these big fancy communities where the HOAs are hundreds, sometimes thousands of dollars, well, normally the rent doesn't follow upward trend with it and you're stuck holding the bag. So go for lean and mean with HOAs and model a conservative rent and verify the CDD. Again, if you're just trying to be pie in the sky, you're going to be in trouble. Look for a property that's already pre-rented possibly, so you know that you're being conservative on the rents, and verify the CDD. If it pencils, you've just bought a real re-rating and a good property. City number 3, Lakeland, Florida. Inventory swell and builder overshoot was causing some issues there. So what do? Use the days on market pressure to negotiate a better deal and also protect your operating costs. I like new build because the new build's going to get me bigger warranties. It's also going to make sure that I stay off of low-lying land. Anything built 2004 or newer is going to be built on that higher structural demand that the government made the rule changes on. And also, if you get a newer construction or new construction property, you can get a nice builder's warranty. That's going to help keep your CapEx low for those first few years, which are pinnacle to start the trajectory of the rental property in the right direction. Closed permits, you want to make sure everything's permitted, and you are going to look for a property management company before closing. A lot of the times, if it's pre-rented, you might already have a property management company in place, which you can just take over. That would be key in Lakeland right now, and I like the idea of buying something that's already pre-rented. Soft pricing plus lower yearly CapEx is how you can manufacture a better spread. New build could get you there in certain affordable Lakeland markets still. Punta Gorda, Florida is city number 4. Now, there was always these post-storm stories about insurance pains in Punta Gorda that are pretty long way past. But again, to keep yourself safe and to keep your returns high, elevation first, make sure everything's at high grade level, living space above base flood. That's where I like new construction. And again, are the rentals in demand? One of the best ways to know if rentals are in demand, is the property already rented? If you can score a new construction property that's recently rented, a lot of your risk goes out the window in areas like Punta Gorda. Of course, you want to make sure that it's been done right. Everything's been CO'd, all the inspections were done, and everything was done above board, fully permitted with roofs and all the work that's been done. And make sure the tenant has high value and is credited for it, is able to truly qualify for the property. And when you have that, tenants don't want to go anywhere because they see the property as storm ready. They're high ground, they're safe, and they like to stay there longer, especially in affordable new construction homes, which weren't as available in certain areas. Yes, the newer, higher priced emotional ones, more in stock there. Stick with the affordable ones. And if you do this, you can win the corridor that everyone else is avoiding and make great cash flow today. City number 5 is Palm Bay. Now, during the pandemic, there was a definite building surge there, and it reset the demand. So our play for you there, absorption is slowed. So this is where you leverage where buyers who can close. So you want to make sure that you're picky and that you're looking around. See if you can structure incentives towards your interest rate buy downs or closing costs, maybe some free property management. And again, are the properties in demand to be rented? If there's a ton of this type of property and none of them are rented, that is a big red flag. Are they pre-rented? Yes or no? That's one of the most important questions you can ask yourself, and avoid the theatrics that way. That will just hurt your overall returns and numbers. If you keep that monthly payment same with affordable and lower insurance rates, you can still go to Palm Bay and get a long-term successful property. City number 6, Tampa. Now, Tampa is a very popular Florida city. We all know it got overheated during the boom. A lot of outsiders coming to live there. It is a beautiful city, but it did overheat, and listings are sitting longer. So the play we recommend is separate Tampa proper from the metro. Micro pocket selection here is everything. Seek employer nodes and commute arteries. This is going to be key for, is there demand on the properties or not? And trading granite for certainty. Let's look at the taxes. Let's look at the insurance, the HOA, the CDD. These are the real numbers, the real bones that are going to make you successful or not. And if all 4 of those things behave and appreciation just becomes a bonus down the road, not the plan, you can be in a great position in a still growing large city. So here's how panic steals your return. You ignore insurance and flood, you ignore CDD and HOA true costs, you budget off the seller's last tax bill. 6 months later, your NOI is off by hundreds per month. That's not a good feeling. One oversight like this, one negative spread, 1 year of returns gone. We refuse to guess, we verify. That's what keeps you safe and builds wealth. So no false hope. Don't just say it hasn't flooded in 100 years. That's not underwriting. The taxes are low right now. That's not underwriting either. You got to recheck what your taxes will be. Only statutes, schedules, maps, and true quotes will decide what your costs are going to be. Trust the paperwork. Get verified quotes on all of these, not just the pitch from the other side. At Southern Impression Homes, we buy in the fear today with rules in place that will also make you money today. We build for insurability. We underwrite with the year 1 tax reset. We verify the CDD, the HOA. We avoid low elevation traps. You don't want that. That can 5x your insurance when that can be avoided with new construction. We deliver everything with a permit trail, the warranty, and property management in place, even free for the first 2 years. So those first years are stable and the trajectory of a successful portfolio is starting in the right direction. So if you're an investor, to start, get some real quotes, 3 real quotes before you contract on the home policy and the landlord policy. Flood if applicable, and check for the wind mitigation credits. You'll be shocked at how different the insurance rates can be when you find that good insurance carrier. Number 2, treat the CDD and the HOA as fixed. Ask for the bond amortization and the operating lines. I like to look at the HOA and see, is it financially healthy? Is it not? Does it look like there's about to be a large assessment coming out? Because I certainly don't want to get hit with it, but if it looks clean, it's a big green go. So number 3, use the county tax estimator with your purchase price, not the seller's bill. What your taxes are going to be can be completely different from what the sellers are. Are you an investor and he's owned the house and is owner occupied for many of years? You want to look at that. Now, new construction is more controllable and you should be able to get a more accurate assessment. Also, going off the full purchase price, you may be giving yourself a buffer. It's been my experience that most times the assessed value does not go all the way up to the purchase price. But if you're doing your numbers with that buffer of going full purchase price, then and it still works, the numbers still work, then you've got yourself a great deal. Now, number 4, prefer new construction with closed permits and a 210 warranty to reduce CapEx surprises. A lot of new builders will offer that 210 warranty, and new construction from thousands of properties that I've done, both fixer-upper and new construction, show that those first 3 to 5 years have a much, much lower amount of repairs and maintenance. And number 5, bid with confidence when properties are on the market past 30 days. Builders want to sell. Sellers want to sell. Make an offer, put it in writing, and that way you'll solve the seller's time frame. And again, if you're coming up to the end of a year end, then make the offer to close before year end, which most people will take a better offer as long as it appeases that timeline. So if you're an agent working with buyers, especially investors, lead with costs, not countertops. They worry about their return. Countertops are great. They want nice ones. But what are the numbers saying? And make sure you pull the permit history, pull the non-ad valorem assessments, and pull HOA budgets and reserves. These are going to really paint a picture whether the deal makes sense or not. That HOA is showing low reserves and the chance for a special assessments. You better do that into the numbers or your buyers are not going to be very happy with you 6 months down the road, and get the insurance conversation moving forward. Find a good insurance carrier that's done lots of properties in the area and get a bid for them. They can get you close to exact what the costs are going to be. Believe me, you do all these things, your client will thank you later. So in the big picture, Florida is not disappearing. The population growth and the economic growth continues, especially in affordable markets. And one thing you have to get used to in market cycles is demand pulses with rates and insurance cycles. We're coming out of a 3-year low in most areas of Florida, and there's going to be winners. The winners, the investors that actually make money, are the people that control the line items that other people will ignore up front. If you build smarter, if you look to be on higher ground that will be rewarded with lower insurance premiums, that's a great start. And verify everything from all the permits being pulled to making sure that everything was done above board. And that way your rental survives any storms or headlines and makes you money for the long term. Now, if you're looking to make money for the long term and want to learn more about how build to rent actually works, then watch my next video and click the like button below.